All right, guys. Well, we've got a good crowd today, and I thank everyone for joining. This won't be some sort of hypey sales pitch. We're just going to kind of give you what we got, show you how it works, and see what sort of questions everybody has. So the majority of you have probably been kind of watching our trades on and off over the past few months. And unlike many products out here in the stock trading world, usually they come at you with a 30-page sales letter or a 2-hour sales video, promise you some kind of crazy return, and then get you to pay for everything up front. And so certainly I had my experience doing that over the last 10 years, representing all sorts of gurus, most of the big names out there. I've represented at one point in time. And what I learned over a decade of doing this was that there's a huge disconnect between these trading gurus and the poor people trying to follow the trade alerts. That was the net result was just simply that regardless of whatever the guru was reporting that he had earned, the bulk of the people following it just did not get that same result. And so there's a whole bucket list of schemes or reasons why, which I'll get into for a little bit. But at the end of the day, who cares if you're not getting the result that's promised? It just doesn't really matter whose fault it is. And so, here's some of the problems I found after representing the best of the best, people who've been doing this for 50, 60 years, managed huge hedge funds, every type of credential you could pile up. We would find these folks and put them into the market, sell a bunch of memberships, and just over and over and over again, people were not getting the result that was advertised, whether it was advertised in the sales letter or after they purchased the product, and they're just not getting the same return. And so this product tries to fix that big problem, and I think it's very successfully doing that. So one big problem that I found in 10 years of doing this was simply that people didn't know when the trade alerts would come out. Seems simple enough, but if you go tell some 30, 40-year experienced hedge fund manager that, hey, you know what, you're going to have to kind of tie your hands behind your back and only trade at a certain time once a week, they do not like to do that. Okay, so that's one thing that was a huge issue, was just simply not knowing when the content would be arriving so that you could plan your life around that time period. So that was one big problem. Another big problem was that they would start trading these very illiquid instruments, whether it was small cap stocks, some sort of crazy option trade. They were trading things where the prices were moving around so fast, it was very tough to get the same price that they quoted. And in fact, oftentimes, especially in the small cap area, these people would literally pump the price just from their own trade alert. So they'd come in there, maybe it's trading at 250, issue a trade alert, put their own money in it, and by the time all these folks had followed the trade, it was already up to 5, and the next thing you know, he's selling it. Now it's going to crash because everybody's rushing to the exit. And meanwhile, he's booking, 100% gain, which is just not fair. It's not right.
Hey, Jackie, how you doing?
Let me mute up these really quick, and then we'll keep going here. I'll unmute this again at the end. So number one is you can't predict when the trade alert will come out. 2, oftentimes they're trading products that are illiquid, and the trade alert itself is moving the market. So you're buying high, they're telling everyone else to sell, then you're selling low and you're losing money. A third problem was that they wouldn't indicate what percentage of your portfolio should buy a given trade alert. And so these sort of folks just crank out an endless amount of trades with no allocation size, and when they start to get wrong in the direction, they just kind of bandage it over with issuing a whole lot of more trade alerts. And so people end up not being able to follow it because they don't have enough money. That's a common trick. Another one is they'll throw out buy alerts all day long, And then the ones that aren't winning, they kind of just sweep under the carpet and hope nobody notices. And all they do is sit there and close out the winners. You know, and then they'll go brag that they've got 100% win rate. We all know that's bullshit. So I'd say those are some of the biggest frauds out there that really has lost so many people money. Okay, so our product is a little different. We're not asking you to read some kind of sales letter or sales video, and we're not promising you big, giant returns. And in fact, what I found in 10 years of doing this is that most of these so-called gurus, they felt like to have value, they had to outperform the market. And here's the next thing I learned in 10 years of doing this. You cannot outperform the market for very long without taking on a lot of risk and really getting lucky. And so we always bring up Buffett bet a bunch of hedge funds that they couldn't beat the SPY over a long period of time, and he won that bet. So it's just very hard to beat the index itself. And so you're going to see what our product does actually takes these index products, and we're going to try to tame them down for you. I kind of relate it to that wild girlfriend or wild boyfriend you had in college. It was a lot of fun, but you just knew this is just too crazy to spend the rest of your life with. And so what we're trying to do is take the best underlying assets that exist. We're talking about the S&P 500 SPY and the TLT. That's the U.S. Treasury 20-year bond ETF fund. So we're taking the two most stable products that exist. And from there, we're going to actually tame them down. We're going to make them less wild, less volatile. And the net result is that we're going to miss out on some of the upside. That's perfectly fine. We don't want to be greedy with this portfolio strategy because our clientele are all going into retirement. And now it's a matter of safety and consistency while protecting the capital. So we're going to give up a pretty good chunk of the potential profit of just buying and holding these assets so that we can ensure that we never have a big loss. And so in a moment, we'll start to kind of go through some of the sample trades so you can just see exactly how easy it is to tame these assets down while still holding the safest products in the world. And so right now, what I have on the screen are the various portfolios that we offer and the current year-to-date return. And so in general, what I really recommend people do is essentially have 45% of their capital in equities. And again, this is not a growth strategy. We're not targeting this methodology for 30 to 50-year-olds. You know, they can take some losses in their portfolio and hang on for a decade or two, and maybe it's not such a big deal for them. But for folks who are going into retirement, you need a consistent strategy to generate income and not risk the boat. So that's what you're going to see is the underlying philosophy with this whole program. So 10 years of doing this, every guru I've met wants to beat the return of the SPY. I'm here to tell you, I'm going to try to tame it down for you. We're going to try to make less than the index returns, but on down days, we're going to have very little pain. And if there's a stock market crash, you wouldn't care less. So let's just go over a quick overview. For some folks, they're really happy just following equity portfolio number one. That's the SPY ETF, traded Monday, Wednesday, Friday. It's a very unique security. It's the highest traded security in the world, about $16 billion a day going in and out of it. And it has something that no other ETF or stock offers. And that is 3 option expirations a week. Now you'll see we do have to adjust the strategy as market conditions change. But in general, our strategy is to sell a call option, which I equate to something like taking candy from a baby. And then we're going to use part of that credit to buy a put option. Super cheap. We're spending maybe 20 to 30 cents every Monday, Wednesday, Friday to constantly have a put option below our underlying asset. And so I'll pull up a trade alert in a little bit. But at the end of the day, we're gonna give up some of the upside profit. And this has been a hell of a year for the SPY. It's up a lot. But on the downside, when everyone else is eating all of the losses, we're sitting pretty because we sold the call, which will become 100% our profit in any kind of downturn, and we own the put. So we have a set loss going into every trading period. And the next most important thing about our program, besides knowing exactly when the trade comes out, is that every trade is self-destruct. It's like the Mission Impossible movie. You get the message, it's good for that moment, and then it destructs. So our trades, every single piece of it is opened and exited at each trading period. So why is that important? Have you ever joined some sort of trade alert advisory and the guy has built some kind of crazy portfolio? You have no idea what you follow now, what you ignore. He got in at 50% less than the price is right now. It's too hard for people to follow that. So our program assumes that you can take the trade at that point in time, and that's all you need to worry about. And at the next trading period, we're going to completely close that position out and redo it. Okay, so for a lot of folks, the Monday, Wednesday, Friday trade is the best. Now you will see it doesn't have as high of a return as our Tuesday trade. That's equity portfolio 2. And it's not trying to have a larger return. Okay, so the SPY ETF is a 504 stock index fund that automatically reallocates the capital for you so that you have a great mix of America's top companies. And because of that, it's extremely hard for any individual or hedge fund to dramatically move the price of the SPY. It really takes the entire world freaking out at the same time to create drawdown in the SPY. And sure, that still happens. But a lot of people do what we're doing on specific stocks. In fact, it wasn't long ago, one of our clients had seen how well we're making money on the SPY, and he starts asking me if he can do the same thing on Tesla. For heaven's sakes. So I think what you'll see as we get into this is that we're going to focus on owning the best assets in the world. And then on top of that, owning a put option right below our price so that we have a maximum loss at all times, protecting our capital. So again, we have the equity portfolio 1 is trading Monday, Wednesday, Friday, the SPY. On Tuesday, we offer an alternative to the SPY. So how do we pick those stocks? Well, I like to look at what the SPY actually purchases for you. And then from that, pick the best stocks in that group for that trading period. So currently, this one's just been riding Apple. Now, what's so great about Apple? Well, first of all, it's the number 2 largest position in the SPY, right under Microsoft. It is the largest position in the QQQ. And there's one other well-known investor who likes Apple. His name is Warren Buffett. That's his number 1 position by far. Nothing else even comes close. So again, we're trying to pick what's the safest asset with the moat built around it that we can buy and hold for a long period of time, and then take advantage of the option market, not to really enhance profits, but rather to tame down that asset and take out some of the volatility. And so this is really a perfect mix for people who are going into retirement. Oh, we just got Chris on board. Hey, Chris.
Good morning. How are you?
Doing good. Hey guys, I want to introduce you to Chris. He's another one of our coaches. He actually started off by buying the program. Chris, give him a quick intro, will you? And then and tell him about your experience with the program so far. And then I'll have Dean do a quick intro, and then I'll go back into my presentation.
Happy to. So I retired 2 years ago, been trading stocks and options and stuff for probably 40 years. And even though I have a lot of experience doing it, basically when the market goes up, I'd go up. When the market went down, I'd go down. And a lot of times when the market went down, I wasn't very happy about it. And so, you know, after you retire, you really want to protect the money that you've made after working your life. So I was getting tired of the regular grind. I had subscribed to a lot of different kinds of services and stuff, and I never, I guess, got it right. Maybe it wasn't the service, maybe it was me, but whatever. So I was approached about Portfolio Builder, and I sort of decided, well, why not? I might as well look at another one, and I did. And actually, I didn't pay much attention to the trial, so I begged them for an extra week right before it ended. And this time I paid attention, and I noticed that I was making money just about every single day. I think there was one down day that week, but one day where I had lost 5,000 in my regular portfolio, made like $300 on this, and that's just trading the spot. And so I thought, well, geez, that's pretty good, you know. And then I started getting more. Actually, I bought the program, and I started. At the time, you could buy the program, and then they give you 30 days of the Diamond program, which we're trading Apple right now. So, literally in the first month, I paid for my subscriptions because it basically was consistent. It was easy. And the best thing for me is my anxiety at trading the market disappeared, because even though we had a down day here or there, it was very small because Jason kind of hedges everything with puts and stuff. So even if it doesn't go as planned, you don't lose very much money at all. And in the end, you just make money. Now I've been doing it for 3 months, and I've traded in 3 of my different brokers, and I'm up pretty significantly in all of them. That's it.
Yep, pretty simple. And I think they didn't hear it. So at one point you said you had a $5,000 loss in one of your trading accounts, and we were up a couple $100 on ours. It was one of the moments, like the epiphany for you, that, wow, we're not getting rich, but we're just slowly growing.
Well, you know what? That's the thing. And, you know, the more you put in it, the more you're going to make. So at first, you know, I just dipped my toe in the water. I wasn't making that much money, but I started putting more and more of my assets into it because, you know, the risk was so limited. The way we do things, it just, you know, it just made sense that I wanted to protect the downside. And I never done it before. You know, it was always like trying to pick the best thing instead of picking something that was good and safe, but then also protecting it on the downside. And I always thought, you know, if I got into a program where I actually believed in and thought it made money, I'd like to share it with other people. And so I've been doing it too.
Thank you very much, Chris. Dean, you want to give a little piece about yourself?
Sure. Chris, thank you for that bit of information. I definitely appreciate it. Team, just want to first off and foremost thank you for your time. You know, I absolutely understand that time is the most valuable asset there is, and you cannot buy it. So thank you very much for your time to join us today. A little background on myself. I've been trading, almost 15 years now, and definitely made a lot of money early on. Lost a ton. I lost 6 figures in a week at one point. I, you know, got overconfident. Anyways, when I lost I had a week. I lost 6 figures. It happened. Complete happenstance was the same week that Warren Buffett openly bet every single hedge fund manager in the world. I think there was over 3,000 at the time. There's less than 2,000 now. But he made an open bet to the world that he was going to, you know, he did just a completely open bet to the world. Said, hey, if there's a hedge fund manager out there in the world that thinks that their fund can beat my performance over the next decade, or they can beat the performance of the SPY over the next decade, I'll pay $1 million to your charity, okay? And I'll take you to lunch to do it. 12 people took the bet. Not a single person beat Warren Buffett, okay? It was literally, I watched that interview and I said, Dean, why do you have all these super risky stocks? And you're going, you know, you're pulling your hair out because you're so stressed out and you can't sleep. Why don't you just own the SPY? You know, the smartest investor in the world is basically telling you if you don't own this, you're an idiot. Okay, so I took his advice. Okay, I bought my shares of SPY, and it's been phenomenal. It's been one of the least stressful investments I've ever had. And then I found Jason's system here, and I said, oh man, there's even a better way to take even more risk off and sleep better at night. And so I tried it, and I was kind of shocked. And what I really think has been really an epiphany for me is to become defensive in a market that's up 456% in the last decade is probably pretty smart at this point. Okay, and then one thing I never did is I never defined my downside. And I think that's been so wonderful. And Jason's really helped show us that. And then, recently I've just been watching the TLT and, keep thinking I'm an idiot for not owning it. So that's going to be one of my next allocations. And, I just think Jason's been absolutely spot on with what's been going on in the macro environment across the world. And what's going on with our monetary policy is just nuts. Owning things like the TLT and precious metals is a fantastic way to hedge that. And it's funny because it's not sexy at first, and this is how all of the people I've spoken to kind of start. They grab the SPY, they get comfortable with it, they do well. Okay, they see how minimal stress is involved in your life when you start trading defensively instead of just openly offensively. Okay, when things get crazy, you have your downside protection. And I've built a decent nest egg now, and I'm having more fun growing it slowly. 1% or 2% a month, great. And I just want to say everyone kind of starts with the SPY. They get comfortable there. And the next thing they do is they want to, jump into the diamond because they see that 19% return, right? Just like you all are looking at right now. And, then they start to get comfortable there. And then the first day the S hits the fan, people are telling me, I did pick up some shares of TLT, thank God. And it's a great way to just stay just super balanced. And all really Jason does is even out the wave and take so much stress out of the market. And that's been phenomenal for me. And I have to say that's, the 100 or 200 people I've worked with to follow us. That's the number one thing they tell me is they sleep better at night. They're less stressed and the down days aren't as bad. It's nice because sometimes on the flat days we make some money too. And that's the background on me. I've known Jason for quite a while now. Jason, I think we're going on 15 years or so as well. So, it's just becoming defensive has just been mind opening for me, and probably the least stressed I've ever been as an investor.
Excellent. Thank you so much, Dean. Between Chris and Dean, you guys don't even need me on the webinar. That's very well said. Got a few questions coming in. Karen says Buffett also said he was an idiot not to buy Amazon. I guess one of his little tiny portfolios finally did pick up a little bit.
Yep.
He's probably, the funnier story is why on earth he didn't buy Microsoft.
Exactly.
I think just because he's playing bridge with Gates the whole time. I think it was just a personal thing where he says he just doesn't understand computers, but apparently he loves his iPhone. Ernest has a question. What time frame is represented? Yeah, all of these portfolios launched in the Christmas massacre last year. So it's had to undergo some pretty crazy volatility in both directions. And it's also had to deal with the central bank who just last December told us that rate hikes were on autopilot. I don't know if you guys remember that. Boy, the stock market sure didn't like that wording. And, yesterday we had the first rate cut in some 11 years. So exciting times. I'll get into my macro view, kind of what I think the big picture looks like. and how I intend to play it. Any quick questions before I jump into all that? I'll also talk about, kind of like a worst case scenario in the markets for everyone and how we would cope with that. Any quick questions before we get into some of the details? Okay, cool. Well, let's go ahead and dive into it. So the general idea here is, if you did nothing else except for just buy the SPY and the TLT, you're probably upgrading your strategy from where you're at right now, just in terms of having a smarter risk profile at your current age and your current time horizon. You throw in some put options below it. Now you're really getting smart, and you start selling call options, and now you're just kind of taking advantage of fools, I would say. Stock speculators. There's a lot of stock speculators out there who, they want to make 100, 200, 300% return playing some sort of news. And they just don't usually win. So it's just usually a free way for us to grab a little money and finance our downside. Now, here's something kind of funny. I was able to it just goes to show how hard it is to predict short-term movements in the market. I don't pretend that I know what's going to happen day to day. And we'll have people pop on the webinar and say, how did you know that was going to happen? With the strikes we're choosing and things like that. But I really don't. What I have is, number one, the wisdom of people who are much smarter than me. So we're starting off with that. We're looking at what Buffett's doing, what Ray Dalio's doing. If you really dialed into what they're doing, we're not too far away from that. Now, we're smaller portfolio size, so we can take advantage of the options market a lot better than someone with, $122 billion can do. So, but recently I had predicted that, let me pull up the trailer. Let's just take a look at today's issue. So I expected yesterday for the Fed to lower rates 25 basis points. I mean, they practically told us that would happen. I expected them to end quantitative tightening. They did that. They didn't hint at QE, which I thought maybe they would do. And so I was expecting a huge rally in equities, but that didn't have me go all in on equities. We kept our nice, boring 45-45 ratio, and the stock market had a hissy fit yesterday. Now it's recovered today, which is fine. We had our downside protection, but it had an absolute hissy fit, and the bond market just took off. So let's look at the TLT. Look at that. Zoomed up higher. And so that part of our portfolio delivered a nice gain week over week for us. Now, the SPY didn't perform as well as I hoped, but it didn't matter because I had a smart overall allocation. And so it's just funny that sometimes you can predict what the news will be in the future, but the underlying assets act a little differently than we thought. And so here's today's trade alert. This is our Thursday trade, and this is primarily trading the bond portfolio. Now, I thought the gold spike from that news, and it didn't. So we lost a little bit on our gold spread, but overall we made $1.09 per share on the TLT week over week. So we made 54 basis points. Not a huge gain, but if you do that week over week, and you have a few losses in there, you can walk away with around a 12%, 15% annual return on this part of your portfolio. So let me just pull up these various portfolios. So again, you can see how I have the capital allocated. Right now, I'm a little heavy on the equities compared to what I've been recommending. I'm a little light on the metals and the anti-inflationary products, but we've had a huge gain in that. Now, we're not trying to get rich with this part of the portfolio. Look at the percentage of it. It's relatively small. And back in December, we were only recommending a tiny position because this is a sort of position you want to have if the central banks are being a little crazy printing money and lowering rates, which they've suddenly decided to start doing. So we've been increasing our allocation in this part of the portfolio. And it's just been back and forth. When the equities goes up, we're seeing a little bit of a pullback in the bond portfolio and vice versa. But at the end of the day, they're just sticking neck to neck. And the general result is that it gives us a very nice, consistent return almost every single month. So let me just flip through it and give you guys a kind of a tour of how we organize our track record so you can read it yourself. Now, every update we send out has a link to this track record. And actually, we give you, when you do upgrade, we give you a copy of this spreadsheet so that you can manage your trades exactly how I am. And I'd say about half of our clients are analytical engineer types, and they like to sit there and punch these in. The other half absolutely hate spreadsheets. Chris, for example, you know, last thing he's going to do is spend his retirement typing in a spreadsheet. So the product has been designed to be so easy to follow, and because you're in and out, completely in, completely out, you don't need to keep track of it in some sort of fancy spreadsheet like I am. But it does help illustrate what we're doing. So here's just a quick walkthrough of the platform so you can see how it works. And in every update we send you, there's a link to this spreadsheet so you can go through it. So up top, we have our current value, profit, return, deposit. In this area, we are controlling how we allocate capital. And for now, it's just trading the SPY. There could be a rare time where I would switch from doing the covered call put, which we call a caller. We would rotate out of the SPY and then buy this basket of ETFs. But that would be after we've seen something like a 30 to 50% correction in the SPY from a big financial panic. So for the foreseeable future and all the way down to the bottom, whenever we do enter the next recession, we'll be playing the SPY. And I'll show you how we can use that SPY to generate a nice, slow, safe profit in a bear market, and why people like Ray Dalio believe we are going to see a long-term bear market. We'll look at why that 2008 and 2000 crash was really nothing compared to what happened just 4 decades earlier than that. And so we'll get into that in a minute. But this is what I call the palette. This is what, you know, if you're going to go start a painting, these are the colors we can choose from to make our artwork. And so for now, it's very simple. It's just the SPY. And I think that'll probably be what we're doing in here for most likely the next 24 to 36 months. So I do think we're probably in the last few innings of the bull market, and that at some point there will be one or two different key things that happen that will create the next recession. So we'll start talking about that towards a little bit later. For now, this Monday, Wednesday, Friday is all in on the SPY. And again, it's a very good product. 504 stocks held in that basket. You can't have a little hedge fund come in there and short sell the SPY and make it tank. But if they want to mess around with an individual company, you know, all they got to do is go buy a bunch of stock, buy some put options, and then dump the stock. You can create some volatility right away. And of course, they do that on weak companies. Tesla is a great example of that. Probably one of the favorites of the short sellers. Down below, we keep track of buying and selling stocks. So this automatically picks up the ticker and the plus or minus on the shares, and it automatically flows up top. So I've told it I want 95% of this portfolio targeting the SPY, and it gave me an alert to purchase 1,700 shares. So you can see the deposit is kept track right here. Now, it's not that hard for you to figure out. If you had 100 grand and you're going to put half of it in stocks, you could probably afford around 100 to 200 shares of the SPY. So again, if you don't want to use a spreadsheet, we're trying to make this so easy. You can do it in your head. You can follow the program. There's nothing that's piling up over time. So it's easy to follow in and out, in and out. We scroll over a little bit. We have our option writing. Now, I wait until closing out the trade to put it in the spreadsheet, because this is a spreadsheet that's open to the public. So that's just to protect our private, our paid content. So you won't see the trade that's current show up in the spreadsheet until after we're closing it out. But you will see it in your trade alert text message and email, as well as the video. So we keep track of our short call options. That's where we've sold the call option up here. And again, that I relate to something like taking candy from a baby. We have stock speculators who want to bet up. They want to double, triple their money. And that's fine. That allows us to finance free downside protection in every trading period. So that'll be a big theme, is that we're going to let the stock speculator gamble. And again, if he wins, we win too. So it's not like we lose by selling that call option. We're giving up some of the upside potential. But on the other hand, when a disaster happens, we have insurance. And that's really critical. Imagine having to have a surgery at this point in your life and you didn't have health insurance. Something like 50 grand a night in a hospital. It just makes sense to have insurance, especially if someone else will pay for it. And so that's the key philosophy here, is that, hey, let's let a stock gambler, who's probably a lot younger than you are, could afford some losses, let him gamble and basically pay for your insurance and also generate profits in a flat market. So here's where we do our open option writing, and right below is where we close it out. Now, sometimes we're doing spreads, and so we will be short a call and then also long a call. So here's where we're doing our option buying. So this is where we're buying our puts and we're buying any call options. This is while they're open. Once we close them, we move them right here. Okay, so look, those put options, you wouldn't believe how many people complain that I've been throwing away, part of their profit on insurance. So the day will come where they'll be thanking me that we have those puts. It almost came yesterday. We had that 300 point swing on the SPY, and of course it miraculously recovered today. So we're back to a profitable position on that trade. But owning this put option is the single smartest thing all of you can be doing, especially if you let a stock speculator pay for it. Okay, so that's the overview of the SPY program. And again, it's not trying to hit some huge return. And actually, it looks like it is selling off today. It was up to 350 just a moment ago. So that's the SPY trade. Again, I recommend 45% total allocation of your capital to this SPY program. Now, for some of you, you don't want to trade 3 times a week. We have an alternative. Now, this is performed at twice the rate of the SPY, and it only trades once a week. Now, that's not because it's just all out better. It takes on bigger risk to achieve bigger gains. And during like the month of May, the SPY program lost around 1% that month. S&P 500 lost around 4.5%. This one lost something like 3%. So it does lose more when the market goes down, but it also gains more when the market goes up. So if you're the sort of trader who would rather do 1 trade a week, you're okay with a little more risk to try to achieve a little more return, this strategy makes a lot of sense, and it's very similar. All we're doing is we're looking at what's under the hood of the SPY. So the SPY ETF takes all this capital, and it automatically flows it into a formula that purchases primarily these 8 companies. So we know that these 8 companies have a huge demand from the ETF world, not just the SPY, but pretty much every index product out there. And there's tremendous, every big bank has their own index product, and they're all buying up this same basket of stocks. Now, from time to time, we will either have a group of those stocks or just 1 or 2 of them. Currently, that's Apple. Apple's back on track to get to all-time highs. So we'll probably say, good job, Apple, once it hits 230, and see which of these companies are selling at a better discount when that happens. Probably the banks will be a good deal after we finish taking profits on Apple. So we've had some great returns on Apple over the past several weeks. And before that, we've had periods where we had the whole basket of them. I know Chris, for a little bit there, because Apple took a little while to really take off, he called me up. He said, you know what, I like Apple, but man, having that basket of 8 stocks sure was fun, because it was every week I was excited to see which one was delivering a huge return. So there will be periods where I think it's safe to do the big basket. But there'll be also times where I'm looking at the macro view and I'm thinking things are risky right now. Let's just consolidate to the single best stock that's set up for this option caller strategy. So Microsoft's a great company, but you wouldn't believe it. It actually has a smaller yield than the SPY, which is crazy. You'd think that a basket of 500 stocks would demand a smaller yield selling call options than a single security, but that's just not the case. Microsoft is so straight lined up with so little volatility, you actually get more yield selling call options on Microsoft than you do on the SPY. So the next best bet, the biggest position in all of these index funds, including Warren Buffett's portfolio, is Apple. So right now, that's where we have our eggs in this portfolio, and it's the same setup. But we'll look at some of these trades in a minute. But this is a good alternative. If you don't want to trade 3 times a week, you want a little bit extra profit, but you're willing to have a little extra risk, this Tuesday trade is a great alternative. Now, the Thursday trade is currently long the TLT. It has the same setup where it could rotate into a more risky basket of bond products, but we're not at that point in time. We're really at the opposite end of the cycle, where we're in the last few innings. So we'll just be playing this TLT for a considerable amount of time. And again, it's doing the same thing. Now on this Tuesday, Thursday trade, we take some of the profit from selling the covered call, and we go for a little extra profit playing the silver and gold market. So I'll talk about why I'm bullish on those products right now. And the last piece of the puzzle is a precious metal cryptocurrency basket that should represent something like 10% of your total portfolio. Now, if you want to keep your life simple, just buy GLD. That's the best, safest one. If you want a little extra potential return, a smart way to do it is to get some of the minor ETFs, which we have GDX and SIL, and then a position in Bitcoin. So again, the general idea is to have a 10% allocation to these products. If you want to really diversify it and get potentially a better profit, you can break it down like we have. If you want to do it really simple, just buy GLD. Now I'm going to pull up a few trade alerts so we can go through the templates, and then we'll look at the big picture, and then we'll go into Q&A. All right, so let's start off with a sample SPY trade. First thing I'll do in the video is I'll scroll towards the bottom of the email and review what happened in the trading period, so you can see whether we made money or lost money and how. Now, we don't win money every time, but we do have a very high win rate, and when we do lose, it's usually much less than we win. So a bad day typically will lose maybe between 10 to 50 cents a share. And on the opposite, on a good day, we're maybe making somewhere between 50 cents a share and up to $2. Usually we don't have a setup that will generate more profit than that. And so there's, on the SPY trades, 3 things we track. Number 1, what did the SPY ETF do? That's where our money's parked. We got to track if it's gone up or down. In this trade alert example, the SPY went up $1.48. Next, we have to track what happened to the call option we sold. In this case, we collected 11 cents and were able to buy it back for a penny. So we had a 10-cent profit. And the put option, you're going to see most often expires worthless. We paid 20 cents. And what happened? We had to lose it all. It expired worthless. So the net result was $1.38 profit per share of SPY. And so I also try to spell, well, that doesn't seem like a lot of money, but what if we do this 3 times a week 52 weeks a year. And again, we're not trying to hit these huge returns. Really, this is the return I want to hit, 13%. If we do a little bit better, great. But if I achieve a bigger return than that, it's because I've taken on too much risk. So if you generate $100 profit 3 times a week, 52 weeks a year, that's $15,600 of income from owning 100 shares of the SPY. Now we're going to generate that profit in a number of ways. Some of it's going to be from selling the call, and some of it's going to be from the SPY simply going up in value. If we do $50 profit on average, it's a 26% annualized return and $7,800 of income. And if we get $25 average profit 3 times a week, which is what we're actually targeting, that's a 13% annualized return. So let's see how this trade setup looks. So step 1 is always to close out the previous week's trade alert. If you're new to the program and just getting started, you won't have to close out the previous trade because you didn't take it. So your first step will just be to buy 100 shares of the SPY. Step 2. Now this is the standard trade. Now we're going to sell a call option above the trading price, and we're going to buy a put option below the trading price. Now this is in a bull market. This is the setup that we like the best. So what does all this mean? Well, if you look at the last trading price on this current trade, it was trading at 301.45. We're agreeing to sell our shares with this sell to open 302.50 call for about $1 profit. Plus, we get to keep the 27 cents if they exercise their right. So we're going into this trade saying, hey, we will be happy to give you our shares for $1 more than they're worth right now if you pay an option premium of 27 cents today. So that guy's gambling that the SPY before the expiration will not only go above the strike price of 302.50, he also has to make that option premium he paid. So he needs it to go to 302.75, and then that's when he can start making some nice profit. So if this were to jump between this time period to 305, that guy's making a killing. He's probably going to make something like a 500% return. On our side, we made $1 plus his 25 cents. That's fine. Now, if he's wrong, he loses all his money on the 27 cents, and we've purchased downside protection. So what is that? Buy to open July 29th, 299.50 put. All that means is we have, now this trade is the opposite of a stock speculator. This guy is a lot more similar to what we're doing, except most likely this person is a huge Wall Street bank. They're dealing with billions of dollars, and they're happy to buy the SPY for $299.50. Now, the only reason we would use that is if the SPY were to drop below $299.50. So we'd want to exercise our right to sell our shares for more than they're worth at the current value. So if something terrible happens in the market, we wake up one day and the SPY's at 280, $20 drop. Doesn't matter. We have the right to sell our shares for $299.50. So that's the general setup we're going to be doing over and over. Now, I always provide you the option chain. I'm not trying to predict the market. I'm looking at Wall Street, seeing where they're selling options, and I'm picking strikes right around that area. So that's the general strategy for how we choose the correct strike. We're really trying to be something like just a little flea on the dinosaur, just a little mosquito. The next thing I provide in every trade alert is your risk graph. This shows you the potential outcomes. So you can see your profit slowly rising as we get to a maximum profit of $109 per contract. And you can see our maximum risk as the SPY were to lose value gets cut off at 191. And that's typically the risk reward ratio that we will do on the SPY if we're predicting an up move. So we'll be essentially risking $1 to make 50 cents and have a very high probability of either winning or losing very little. Now, in a moment, I'll show you, in fact, I'll do that real quick. Well, I'll go to the downside in a moment, but as far as we're concerned, this is the setup that we've been doing all year and that we'll be doing in the near future. Now, a lot of people want to ask, well, what if we go into a bear market or a recession? How are we going to make money owning the SPY? And I'll show you how to flip this chart so that we actually get $2 of profit while we risk $1 if we set this up to be flipped. We get the chart of the SPY. This was just an extra chart. Sometimes I'll take a look at the volatility index for big volume picking up. That can be an indicator that potential risk is ahead. And that's something we actually saw this week with some huge buying at the 50 to 35 cent range on the VIX calls. And then we give you our updated track record. Now I'm taking this screenshot after closing out all the trades from the previous trading period. So you can see what our net result is at that point in time. And below that's a link to the spreadsheet. So you want to go through it, go for it. Below that is our summary of what happened from the previous trade. And then that's really it. Now let's look at how similar the rest of the trades are. So here's the TLT portfolio. Same thing, look, we're selling the call option above the trading price. Actually, that was closing out the last week's trade. Let me go to the new week's. So you can see the TLT, when we entered this trade, was at 134.08. Sold that call option $1.40 above. So if TLT flies higher, I keep $1.40 profit before I have to sell. Plus I get to keep the 34 cents. And what did I do with part of that credit? I bought myself a put option. So if the TLT were to crash for a number of potential reasons, the worst case is I get to sell my shares for $131.50. It could be at $115 tomorrow, and I still get to sell mine into the big bank who's happy to pick up these shares because he wins this trade 99% of the time for $131.50. So again, we're taming the asset, we're reducing the volatility. Pretty similar setup. Now the TLT has less volatility, so it's an even, typically an even worse risk to reward ratio, but it's the same setup. Now in this trade, this is a little bit more advanced class, the Tuesday, Thursday trades. We take part of that profit, that credit we took in, and we're trying to double that credit playing a long-term play in the gold market. So you can see I'm taking that $25 credit and I'm buying a $29 debit in a bull call spread on GLD. And so this is something we'll be doing quite likely for the next 2 to 3 years with the profit we're pulling out of the TLT in each trading setup. And so I don't need to own GLD to do this trade. I just take the credit, buy the call, and then sell the call. So I'm buying a call for $1.45, and then I'm selling a less valuable call for $1.17. And essentially, I'm financing a very cheap bet that GLD will just go up. So in this setup, as long as GLD just goes flat or up, I can generate a 90% profit on that credit I took in. So we're not risking a lot on this, but if you do this every week with the piece of the profit from the TLT, it's going to help add up some extra profit in our portfolio with very little risk. Another look at the option market. And again, these are all designed to survive what I call atomic bomb proof trades. Because if it ever goes below our put, we're set to jet. Doesn't matter. We own the put, so we're better off just waiting to see if the underlying asset rebounds by the next trading period. So this program trades Thursday at noon. The SPY alternative is Tuesday at noon. And then if you want to trade the SPY, it's Monday, Wednesday, Friday. Here's a recent Apple trade. And it actually had some long calls going into that trade. We can go to the summary. This is one of the better returns we had in this portfolio. You can see Apple jumped from 205.17 to 207.92 for a $2.65 gain. The caller That's what it's called when you sell a call and buy a put. We took in a credit of 6 cents. We had to pay back $1.57 to get out of that. So we lost money on that, but a lot less than we won on the underlying asset. We had some long calls on the minor ETF GDX. Those added some extra profit. Now, we didn't buy the GDX ETF. We just bought the calls. And it was relative to how many shares of TLT we own, or rather Apple. So in this trade alert, we generated a profit of $2.66 per share of Apple, which is a huge return over a long period of time. 100% return. But again, we're not trying to achieve that type of return, more like 2% a month. Now let's talk about some of the macro ideas that are probably going to influence the markets over the next 3 to 10 years and how we're going to deal with it. So this is the most important chart for predicting the stock market and the bond market. And that's just the effective federal funds rate. And so the prediction from Ray Dalio and all these folks is that when in trouble, the government and the central banks will lower rates and print money until they can't. So our expectation is, because of this US-China trade war, which has no resolution in sight. Quite frankly, I don't think the Chinese want a trade resolution. They want America to go into a recession so that they can try to leapfrog into the #1 economic power. So if we go take away all their advantages with the trade war, with the trade deal we've sent them, 2,500 pages, they would not have a chance at taking over the #1 spot. So they talk about their 100 years of shame. You know, they're not about to just throw in the towel. So anyways, what's the expectation? My expectation is that this rate will go down close to 0. It'll just stay a little bit above whatever we see out of Europe and China. And they're going to print as much money as they need to fund the US government and its huge deficit. Huge deficit. When we have a debt ratio, let's look at this. Every time our debt gets above 100% to GDP, we come into a very nasty period in time. So it's no coincidence. You go back to the 40s and into the 50s, we were sitting on this huge debt to GDP ratio. You just get to a point where you really can't afford the interest payments. And so what ended up happening? Well, let's take a look at inflation. There's only one thing that'll make the Fed move, that'll force them to stop printing so much money. Okay, and it's happened to Germany in World War II. It's happened all over the place, but it's even happened in America. And if you print too much money, eventually you get inflation. And so they're all talking about how they can't get any inflation. Well, maybe it's because they're financing these huge global corporations who are selling products practically at a loss because they can get credit for free. So they can go in and have an unprofitable business model. Think of Netflix. Think about how much debt they're racking up. We're paying $10 a month for them to put together. I think just in the next 3 months, they're spending $500 million on 3 movies. We're paying them $10 a month. It's nuts. So my expectation is they will lower rates just a little bit above everyone else, keep the yield a little bit attractive to foreign investment, fight the US-China trade war, feed the government this huge deficit that it demands until they can't. And the only thing that's going to stop them is inflation. So we start to get runaway inflation. If we go look at this period of time, you can see in the 60s and 70s, we got to a point where we're having 10% inflation. And so what did they have to do? They had to raise the rates all the way up to 19%. It's insane. What happened to the stock market during this period? So you look at the big picture, and now all of a sudden these horrific 08 crash and dot-com bubble, wow, they don't really look that bad now. Not compared to this period of time. What if today's market's something like it was in 1965? We have a few more years of blowing out the bubble, and then we enter a long-term bear market. And sure, there's these rallies in between, but the general trend, if you had bought in 1965, it would have took you 30 years to get back to even. So people following our program cannot afford to go flat or lose for 30 years, much less a year or two. A lot of people think the next crash will be something like the '08 crash, which was half the period that the dot-com bubble lasted. But people like Ray Dalio say, no, we're coming into the next long-term credit wave, not the short-term credit wave. These are the small waves. He's saying we're entering a 30 to 40 year recession where they're going to have to fight inflation because they've printed too much money, and that we're in the last several innings. So it's very hard to time it. You know, it's very hard to time it. If you bet down, the chances are you'll lose in the short term, even though we know what's coming at us. So with that said, let's talk a little bit about how we can reverse the strategy and generate a safe profit in a down market if and when that does occur. And I think that with almost certainty, we can predict that the Fed will keep lowering rates and start printing money to buy the US government's deficit, because we cannot afford all the bills that are coming up, and nobody wants to fix the budget. You know, the Democrats certainly don't. You know, all they're talking about is how fast can we print money and take it away from the rich and give Medicare to all. And you know, Trump is a real estate guy. He wants to borrow as much money as he can and go big. His plan is to spend so much money and boost the GDP that we can reverse this GDP to debt ratio. So maybe he'll pull it off, maybe he won't. But certainly the plan right now is definitely looser monetary policy, and probably the beginning of the next round of the central bank buying U.S. treasuries, potentially to the tune of $50 to $100 billion a month. So that's why we like to have those precious metals in this environment. So let me show you guys how simple it is for us to take this trade. Let me fix it up. Wow, now look at this. SPY is at 295.40. All those folks have been squealing like little pigs because they've been losing money on the put are up huge on that put. It's saved their ass today. How funny. Yeah, all year they've been squealing like little pigs that they're giving up profits on the put. You don't buy insurance to get rich. You buy it to save your ass. And that's exactly what it's done for us today. But yeah, let's take a look at how we can alter this trade to do well in a down market. So let me readjust this. We're currently trading at 295. So I'm just going to do our standard trade. Okay, so here is our typical trade setup where we own the underlying asset. We think the market has a better probability of going flat or up than down. So we're selling an out-of-the-money call option and buying an out-of-the-money put. So we have a risk of $235 max if the market were to travel lower, and a potential profit of $165 if it were to travel higher. And that's where our maximum loss and our maximum gain come into play. So that's a good setup. Very hard to lose too much or win too much. And we know in general with low rates, less pressure on the bond market, stocks should go up unless the earnings start to decline. And so far we've had record profits from Microsoft. Apple beat its earnings. Amazon was a little bit sad, but hey, they've been, you know, they haven't had a single losing year since 2000. So the leaders are doing fine. But let's say that started to deteriorate. Let's say that global slowdown finally started forcing the top echelon companies that we're focusing on to revise lower guidance on earnings. Well, this market is super leveraged. If there's just a small panic, it can quickly sell off. So how would we deal with that? Well, let's try this. I'm going to just flip the 297 call to 293. I'm going to switch the put to 297. Let's see what happens. Voila. Same deal, same setup, but now we get a better risk to reward ratio. Now we can make $250 and only lose 160. And in fact, we can even do better than that. So if the market were to say jump up when we first entered this trade, we might get assigned on the call option. That means we get to keep the credit, which is a very nice premium, in this case, 346. Now we are agreeing to sell our shares for a little bit less than they're worth, but there's a spread in there that's our profit. So we could end up assigned going into cash from today to tomorrow if we did this trade and the SPY jumped up, even just $1, and then we'd still be long our put. So then maybe the next day the market crashes and we get a double payday on the put. This is the only safe way you can possibly short the market consistently and not lose your ass if you're wrong. If you try to buy put options and short the market, I'm sure you've done that. It's extremely hard. If you get the timing wrong at all, everything goes against you. You end up with huge losses. So this allows us to put our total portfolio to work. Yeah, Dean says TLT. He also, yeah, here's why you gotta, we got a lot of people who like to try to pick which of my portfolios will be the hottest instead of just following the instructions. You just follow the instructions. It's super hard to lose. If you have half in the bonds, half in the TLT, here we go, TLT 134.66. Meanwhile, what's happening to everybody's stock portfolios? Don't go look right now. Probably sitting on some pretty hefty losses if you're holding any stocks. And whatever the SPY is losing, I guarantee you the individual stocks you own are losing far more. But our members own a put. We own the put, so our losses are already capped off. We can't lose anymore. Everyone else is hopefully watching and getting out. So let's go back to that risk chart. So we try to short the market with a product like a call option on the VIX. Sometimes it just spikes up and it comes right back down. You miss out on selling it. You buy a put option, it's losing value every day. So with this setup, we're actually taking advantage of the guy who wants to bet the market's going to keep going up to pay for our put option. So the market could fly up. We get a nice profit out of our call. We get assigned. So now we are in cash and we're still long the put for an unlimited potential profit. So it's a really smart way to profit from a downturn. So I have not issued a trade of this nature yet this year. And that's because so far, nothing has come out that would cause me to bet down for a considerable amount of time. So there's three things I'm really interested in. Okay, the single most important thing is obviously the earnings of the American companies. So if we start to see the earnings are pulling back, that could quickly cause a lot of panic in the market. So we definitely follow the earnings of the most important companies. That's number one. Number two, if the Fed, for any reason, were to raise rates, that's very bearish for both the TLT and the SPY. So we're definitely an astute studier of not just the Fed, but also the other major central banks. Okay, so usually the Fed's just copycatting what China's doing. So that's the next thing we're following very carefully. And right now it's pretty clear they're going to lower rates and print money to support the US government's deficit. Now they haven't said that yet, but they're trying to slow this out as long as they possibly can. So I think we'll start seeing hints of that in the September meeting. Okay, the next thing, there's only one thing at this point that would really force the Fed to raise rates. Well, there's really two things. One, if the US-China trade war really resolved and everything was giddy and great again and global growth was back on track, all the central banks want to raise their rates so that they have ammunition to fight the next bear market. But that's probably not going to happen. China knows they may have to crash their own economy to crash ours. But that will give them the chance to leapfrog ahead of the US. And if you listen to all of their speeches, that's exactly what they intend to do. So being hopeful of a China trade deal, good luck. The Russian Cold War lasted 3 decades, multiple presidents. This is not a 3 to 4 month fix. Okay, so what would stop all of the money printing? There's only one thing. It happened to Germany in World War II. It's happened to smaller countries. It's happened to the US during the 70s. It's runaway inflation. So they want it to hit 2 to 3%, but not more than that. So they're probably going to overshoot it. In fact, they've told us they want asymmetrical inflation. Essentially, it's just an excuse for them to try to push the buttons even harder in terms of printing money. So that's why we're seeing so much front running into the gold market before there's any inflation. They're predicting this is all going to happen. So that's the 3 big things that are easy to follow. And as long as we have the general concept right, we can almost close our eyes and do the same repetitive trade and not get whiplashed around by the small moves in the market. And that's how we've generated these returns. We have a very smart allocation strategy, and we have the big macro view in place. So we just repeat the same trade and know that we'll have a very high probability of winning, and we're mitigating our potential losses. So you do that consistently, mechanically, and it really adds up. So that's the end of our presentation here today. Let's go ahead and open it up for questions now. And I do want to say we do have a deal that we've extended until Friday. I know it's not July anymore. You do want to save money on a lifetime membership. Call Dean, 505-322-7515. Let me go ahead and open this up and see if we have any questions. Okay, I've unmuted everyone, so if you want to chat, please do. Any questions out there?
Hey, Jason. One thing I really like your macro view on is why we're buying the TLT with a portion of the portfolio. Can you touch on that for a second?
Sure. So, U.S. deficits, something like $21 trillion. Interest payments alone are going to be insane in the next year. So it would seem kind of crazy to buy bonds. The yield is so tiny that, there's no real reason. They're targeting 2% inflation, yet they're paying out 1.5%. So that doesn't make sense. So why are so many people buying TLT? Why is it pushing to all-time highs today? Well, if you knew that there's $16 trillion of sovereign debt where you actually have to pay them for the right to own the bonds, that's when you realize things aren't so okay across the globe. And so what we have is a rush to safety. People aren't trying to get rich from the TLT. They're just trying to not lose. And so we're seeing primarily, while China and Russia have stopped buying treasuries, and don't be fooled, they need US dollars to operate their economy. They can't buy things in their own local currency because it's not trusted. So they need dollars. So they are just spending these treasuries to finance all their purchasing, and they're running out. But we're seeing Europe and also the local primary dealers in the US, all the smart money has been flooding into the TLT. in expectation that the Fed is forced to slowly, gradually drop those rates and keep pushing bond prices higher. So it's the ultimate safety spot. But it's also at risk. If we start to get runaway inflation, then you're going to have nothing safe. That's when we'll have to flip our collar and bet down. But most likely, equity market pops first, huge flood into the TLT and precious metals, and then the bond market pops, and then eventually gold will just be so insanely valued that will pop too, and we'll have a grand reset where we start paying off all this debt and get back to some sound economics here. What we really have to do is get these rates up and get all the malinvestment out of the market. We've been living on a 0% rate for 10 years, and it's created so many funny money businesses that don't really generate profits. They just borrow money, create great, cool products, but they don't generate profits. Maybe the long-term outlook for Netflix is great, but in the short term, companies like Netflix and Tesla and Beyond Meat, they just have these insane losses, huge amounts of debt, and low cash flow. It's not a sustainable strategy if they don't have free credit.
Thanks, Jason.
Karen, I know you got a question out there.
I got a lot of questions. Can you hear me?
Yeah.
Okay. Yeah. I was just curious about that last example that you used. And I was just happened to be looking up, and I noticed that there was an announcement. Trump's going to go ahead and put 10% tariffs back on China on September 1. Boom, market starts to go down, and that's what happened while you were talking. I know you only do your alerts once a day or once, depending on your portfolio. But in a situation like that where it's so extreme and because everything is so volatile right now, would you make an exception to your rule to send something out, like, go ahead and take your profits on that put and then reset it to a lower strike?
Oh, great question, Karen. So when we first started the program, we were trying to, and our clients loved it. We weren't buying the puts. We're just selling closer to the money covered calls, which it gives you a little bit of protection. It gives you a tiny bit of, if we want to protect like 50 cents to $1, we can sell call options and achieve that. And if the market goes lower, I was throwing out emergency alerts. But I started to think about this. I was thinking, what is the number one reason people don't get the result advertised in the trading product? And it's because if you can't predict exactly when the trade is going to come, you're not going to get that result. So that's why we switched from just doing the covered call to doing the caller. And now we have what I call atomic bomb-proof trade alerts. And in general, I would say, Karen, that over trading is a huge mistake. And we're better off just being a little patient, because half the time the market pops right back up after having a little bit of a fit. So like right now, for example, let's look at the SPY. If we had just done what all these, I call them the hecklers or the peanut gallery. If I had listened to the peanut gallery over the last month, bitching and moaning about owning put options, you wouldn't believe it. These are millionaires buying the SPY at all-time highs, generating great profits for the last 6 months, bitching and moaning over and over about the puts. Well, guess what? Today, they're thanking me, and their losses have already tapped out. So they could rush and go sell that put, but they don't need to. We can do it tomorrow, and who knows? Maybe the market bounces back into a profit. But either way, we had that put, so there's nothing to worry about. So at the end of the day, our trade setups don't require that you freak out and go do something. What we're trying to do is have a high probability trade with very low maximum risk and rinse, wash, repeat over and over and over again. So if we had followed all the heckler's advice and not had the puts, we would be doing just that right now. I'd be saying, sorry guys, I got to end this webinar. I'm freaking out. I got to tell everybody to sell the SPY, write a new covered call, do this and that. No, 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 no. Our setup from yesterday was perfect. We're completely protected. There's nothing to worry about. So the answer is no. You will trade at noon Eastern, and that's it. Not for any other reason under the sun. And it's been designed to perfectly work that way. Now, does that mean we couldn't have some sort of high-speed frequency trading system that was doing more trades? Sure, but you know, that's what the big banks do, and they have billions of dollars doing that. We're just a little tiny minnow in the ocean, and we're just trying to go with the wave. We're going with the flow, and we're just pulling the easy profits out of the market. And so absolutely no. There will just be a trade at noon, Monday, Wednesday, Friday for the SPY, and that's it. And it's designed to work perfectly by doing just that.
Thank you for the explanation.
And look, if you follow the advice, what did I say? SPY goes down, what happens to TLT? Pops right up. Now, I have had people who, this is a huge mistake people do. They want to follow the portfolio that just had the big gain. And even when it's just not our products, but just in 10 years of doing this, they always want to chase the hot trade. Oh boy, is that a bad idea. So what, if you got anything from this, it's realize you cannot predict everything that's going to happen on a granular level. So what we have to do is look at the big picture, allocate our resources in an intelligent way, and then sit back and let the different assets do their job at the right time. And so this is a great example where our SPY hit the put. So the max loss is already hit on the SPY. But meanwhile, the TLT is skyrocketing up. So we're perfectly fine. All right, let's look at the GLD. Wow. Here's the better trade, Dean. Let's see what's going on SLV. Oh, wow. We're just straight up long the SLV call right now. That's from our Tuesday trade. So does that make sense, Karen? It's just simply designed so you don't have to do that. We don't want you being a day trader. We want you to have a nice, easy retirement with low risk and consistent returns. William, I know you got a question, buddy. What do you got for me? Ernest, I want one more question from you too. All right, well, I think we did a pretty good job explaining all this. Karen, you got another question?
I'm thinking.
Tom, you got your hand raised, but I think your mic is muted. You want to try to unmute?
My hand should be down. I'm just listening. I'm doing all right.
Well, come on, Tom. I need a question out of you.
Well, I'm okay. My question is on, am I still active? Yeah. My question is, when you reverse that, the graph, I'm having trouble, yeah, that. I'm having trouble getting my mind around the fact that you're selling, you're selling a call that has a lower strike than the put that you're buying. It just,
Yeah, easy. All right, let's talk about that, okay?
Huh?
All right, let's talk about that. All right, can you see my mouse? What's my mouse pointing at right here?
Wait. Yeah. Oh, okay. Up here. Yeah.
What price do you see on the SPY?
Price I see on the SPY is, what is that? 234. No,
295.
295. Yeah, 295.
Okay, now I'm agreeing to sell it for 293, right?
Yeah,
All right, so what loss is that?
$2.
$2. Now tell me this. Tell me this, Tom. How much are they paying me to sell it for a loss?
$3.
$3. So how much profit do I make?
Plus.
So not talking about the put right now, but talking about the call.
Yeah.
If the SPY goes up at all, probably the guy who bought that call, what's he going to do?
Right.
He's going to exercise his right.
Yeah.
So he's going into it with $1 loss because he's paying $3 to make $2. So basically, he's probably not going to exercise the right unless the SPY goes up $1.
Yeah.
Let's say for fun it goes up $2. So he's going to have spent $3 on the call and have a $1 profit. So those in the money call options, I would say, is a smarter call option to buy. So if the SPY went up $2, he's pocketing maybe about a 25% return. So he'll say, sure, I'm going to go for it. So, all right, fine for us. We'll take $1 profit. We agreed to it. We have no option. We have to do that. So tomorrow, so we go into this trade right now. SPY rebounds $2. The guy says, you know what? I'm going to exercise my right. I want to exercise my right, take a 25% profit. That's a great gain in a day. Hallelujah. All right. Okay, so we're going to do that. We're in cash. But guess what? We still own that put. So the put's lost a lot of value. Okay, but it isn't in the money put, so it's not losing a tremendous amount of value. And then let's say the next day, tomorrow, SPY drops another $5-10. Then we can sell that put for a nice profit. Now, maybe it doesn't. Maybe the SPY just keeps going higher. All right, well, we lost 270. We lost our put option value because the SPY kept going higher. So at the end of the day, we can bet down safely with this setup. There's no other way in the world to do that. If you just go buy put options, good luck. That is a tough game.
Yeah.
Very tough game. God knows I've tried to do it. It's tough. In fact, the first thing I did in 2009 was buy a damn $20,000 put option and the market was going to go up for 10 years. I didn't have a clue what was going on. Just going with the trend. That's what a lot of people like to, that's what newbies do. Whatever the current trend is, they think it's going to keep going forever. So it's happened to all of us. But yeah, this setup right here, if you take nothing else, I don't think we're at the point where we're in a long-term downtrend right now. Not at all. But if I were, this is the setup I would be doing.
Yeah. I understand now. Okay.
That's easy.
Yeah.
And it's hard, so that's the trick. You just flip those strikes.
Great question,
We
Tom.
can make some extra money if we get lucky. If we get assigned on day one and then the market dumps on day two, we can make more than this graph would allude to. We can make a lot more. Ernest says, how much is the cost of the program? We have different plans, Ernest. I'll have Dean get a hold of you and get you taken care of if you do decide. But we have a discount, 60% annual discount that's good through Friday. So you might as well take advantage of that while you still can. So. All right, gentlemen. Well, thank you so much for your time. We went for about an hour and a half, so I'll let you guys go. We have another webinar next week. Content is pretty similar week over week. If you do ever upgrade, we move you to our Wednesday group. So we'll spend a little less time kind of reviewing the basics, and we'll get into a little bit more of the technical details, predictions, talk about some of the recent trades, things of that nature. So it does kind of take you a little deeper down the bunny hole. But I hope you can see that essentially we're just buying the safe assets and trying to tame them down a little bit by taking advantage of the option market. All right, guys, thank you so much, and looking forward to seeing you guys next week.
Thank you, Jason.